Euro to US dollar just staged the biggest reversal off yearly lows in 18 months. But here's the thing, the smart money didn't buy this breakout. In fact, the COT data shows something completely different. I've been trading this pair since the 2008 crisis, and this setup smells exactly like the August 2022 squeeze. Wednesday's CPI is the trigger, and if we break 1.1560, I'm targeting a full retest of 1.1649. But there's a catch, if we lose 1.1500, this whole reversal narrative collapses. Want to see my exact entries, stops, and 2 scalping setups? Full analysis is live on the channel right now. Good morning, traders. It's your name from Alpha Market Meridian. And if you're watching the Eurodollar right now, you need to understand what's happening beneath the surface because the price action you see on your screen is only half the story. Last Friday's jobs number shocked everyone. We saw a contraction of 23,000 jobs against an expected 80,000 gain. And that number was so ugly that it effectively killed the narrative of a resilient US labor market. But here's the thing, the market had already positioned for a weak number, and what we are seeing now is institutional money fighting over what comes next. I've been looking at the COT data all weekend, and what I see is a massive US dollar long position that's suddenly sitting on the wrong side of the trade. This is the kind of setup that can produce violent moves when it breaks. And I think we're at that inflection point right now. My analysis today is going to show you exactly why 1.1649 is the most important level on the Eurodollar chart right now, why the institutional flow suggests a sustained move higher is underway, and most importantly, I'm going to give you the exact trade setups, 2 scalps and 1 swing, with the precise levels I'm watching for entries, stops, and targets. This is not a generic market update. This is the analysis I'm using to position my own book, and I'm sharing it with you because I believe this moment deserves clarity, not noise. Let's get into it. Let's cut straight to the verdict before I get into all the nuance. My overall bias on Euro to US dollar for the coming week is bullish, but with a very specific caveat. I want to see a daily close above 1.1560 to confirm that the April downtrend line has been broken convincingly. If we get that, my target is a retest of the 1.1649 level, which is the macro trend invalidation level that would completely flip the narrative from bearish to bullish. The invalidation of this entire bullish thesis is a break and daily close back below 1.1500. If we lose that psychological support, then what we've seen over the last week is just a liquidity grab, and we are heading back toward 1.1419 and potentially lower. So here's your key takeaway. Everything in the Eurodollar right now hinges on this 1.1500 to 1.1560 range. The market is coiling tightly, and when it breaks, I expect the move to be sharp. I want you to watch that 1.1560 level like a hawk because that's where the institutional money is going to make its decision. And before you ask, yes, I've seen this exact divergence between technicals and fundamentals before. Back in August 2022, we had a similar setup where the dollar was overextended, positioning was extreme, and the euro staged a massive squeeze that caught everybody off guard. That's exactly the kind of environment we are in right now, and the smart money is already positioning for it. Now let's get into the technicals, and I'm going to go from the weekly all the way down to the hourly to give you the full picture. Starting on the weekly chart, we've seen a massive outside weekly reversal off the yearly lows. This is a powerful candlestick pattern that often signals a trend change, and it's the first real sign of bullish strength we've seen in months. Price is now trading above the weekly 50 EMA at 1.1480 and the 100 EMA at 1.1480, so those are both acting as support now. The weekly RSI at 45.22 is neutral, but the important thing is that it's moved up from oversold territory. That tells me momentum is shifting to the upside. The MACD on the weekly is still negative, but the histogram is shrinking, which is classic early confirmation of a trend reversal. Moving down to the daily chart, this is where things get really interesting. We are trading at 1.1542, which is just below the daily 200 EMA at 1.1559. Price has been consolidating near 7-week highs, and we are seeing a Classic squeeze between the 50 EMA at 1.1540 and the 200 EMA at 1.1559. This is what I call a compression zone. When you have two major moving averages so close together and price trading right between them, it usually precedes a significant expansion move. The ADX on the daily is only 18.40, which confirms we are in a weak, consolidating trend. The CCI is at 12.50, hovering near the zero baseline, so no momentum in either direction yet. The RSI is at 45.22, which is beautifully neutral after cooling down from the overbought spike we saw on Friday's NFP reaction. What stands out to me is the MACD on the daily. It's still positive, but the upward momentum is fading. That might sound bearish, but what it actually tells me is that we are in a healthy consolidation after a sharp move. Price is holding above the weekly support levels, which I consider more important than the daily noise, and the overall structure is still bullish as long as we hold 1.1500 on the 4-hour chart. We are wedged between the 50 and 200 moving averages. The 4H is actually neutral, which is a bit of a warning sign because it means there's no clear momentum direction. This is often a precursor to a breakout. When the 4H goes neutral, the next move can be explosive. The 1-hour chart is showing a slight intraday bearish bias, but that's just profit-taking after last week's move. I've seen this pattern dozens of times. Price pushes hard into resistance, pulls back to digest the move, and then resumes the trend. The key question is whether the pullback holds above 1.1540 or breaks below into 1.1512. Now here's a personal observation that I think is critical. When I look at the correlation with euro to Japanese yen, I see that the cross is also finding support at key levels, and that's typically a leading indicator for euro to US dollar strength. The dollar block currencies are showing similar weakness against the euro, and the broader dollar index is breaking down from major resistance. This isn't just a euro story, it's a dollar story. The entire dollar complex is under pressure, and that's why I think this euro move has more room to run. Let me connect the fundamental story to the technical picture because this is where we really see the game theory at play. Last Friday's US non-farm payrolls report was the catalyst, a contraction of 23,000 jobs against expectations for an 80,000 gain. That is not just a miss, that is a complete narrative shift. The market is now pricing the odds of a September Federal Reserve rate hike at roughly 50%. Down from around 70% before the data. That is a huge repricing in a matter of days. But here's the nuance that most retail traders are missing. The Fed doesn't just look at one number. They're going to wait for the CPI data on Wednesday, and that's why we are seeing this consolidation. No one wants to commit aggressively before CPI because it could either confirm the dovish narrative or completely invalidate it. The forecast for US CPI is calling for an annual rate of 3.1%, unchanged from the prior reading. If we print below 3%, the dollar will get hit hard, and euro to US dollar could easily spike toward 1.1649 and beyond. If we print above 3.3%, all bets are off, and we could see a dollar rally that pushes euro to US dollar back toward 1.1419. Meanwhile, the Eurozone is actually showing signs of life. The Centix Investor Confidence Index jumped to plus 0.9 in August, turning positive for the first time since February. That's a big deal because it suggests that the Eurozone economy is bottoming out while the US economy is starting to crack. German inflation is running at 2.8% year-on-year, which is above expectations and gives the ECB less reason to cut aggressively. The policy divergence narrative is starting to shift in favor of the euro, and that's what the smart money is positioning for. The institutional positioning data from the CFTC is telling me that large speculators are still heavily long dollars. This is the most important part of the puzzle because when everyone is on one side of the boat, it doesn't take much to tip it over. If we get a soft CPI print, those long dollar positions will be liquidated aggressively, and that's going to fuel a euro rally that could target 1.1800 over the coming weeks. If we get a hot CPI print, the dollar longs will be validated, and we could see a sharp sell-off back toward 1.1400. Today's calendar is relatively quiet. We have the US NFIB business optimism index with a forecast of 97.8 against a prior of 97.4. We also have Fed Governor Bowman speaking, which could move the market if she makes any hawkish commentary. But the real event is Wednesday's US CPI and the German CPI on the same day. That's the double whammy that will determine the next major direction. Now let's get to the part you've been waiting for, the actual trade setups. I'm going to give you 2 scalping plans for the next 24 hours and 1 swing trade that could capture the bigger move. Remember, these are my personal trade plans, not recommendations, and you need to adjust them based on your own risk tolerance and account size. My first scalping setup is based on the mean reversion thesis. We are trading in a range between 1.1540 and 1.1560, and in these compressed environments, I look to buy dips into support and sell rallies into resistance. The long scalp trigger I'm watching is a dip to 1.1540 with a clear rejection on the 1-minute chart. I want to see a wick that breaks below 1.1540 but closes back above it within a few candles. That's classic liquidity grab behavior. Entry would be at 1.1542, stop loss at 1.1532, that's 10 pips of risk. My first target is 1.1555, which gives me a 1.3 to 1 risk-reward ratio, and my second target is 1.1565 if momentum accelerates. The invalidation is a close below 1.1530 on the 1-minute chart, which would tell me that we are breaking down from the range. The second scalp is for the short side. I'm looking to fade any rapid, unbacked spikes into the 1.1560 to 1.1570 zone. This is the area of the 200-period EMA and the near-term resistance. If price spikes up there without a clear fundamental catalyst, I'm going to look for a short scalp. Entry would be at 1.1562, stop loss at 1.1576, 14 pips of risk. Target is 1.1545, which gives me a risk-reward of roughly 1.2 to 1. The invalidation is a decisive breakout above 1.1580, which would tell me that the range is breaking to the upside. Swing trade setup. This is the trade I'm most excited about. The swing trade is based on the daily close breakout above 1.1560. I want to see a daily candle close above 1.1560 to confirm that the April downtrend line has been broken. The entry point for this trade would be on a retest of 1.1560 after the breakout. So if we close above 1.1560 on Wednesday or Thursday, I'm going to place a limit by order at 1.1560. Stop loss will be at 1.1500, that's 60 pips of risk, which is well below the daily swing low. My first target is 1.1649, which gives me an 89 pip profit and a risk reward of 1.48 to 1. My second target is 1.1800, which gives me a 240 pip profit and a 4 to 1 risk reward ratio. The invalidation is a close back below 1.1500, which would invalidate the entire bullish thesis and tell me to exit the trade. Let me pause for a second and share a personal observation with you. I've been trading this pair for 2 decades, and the setups that look too obvious often are exactly the ones that work. When you have this level of institutional positioning, this kind of technical compression, and a major fundamental catalyst like NFP and CPI back-to-back, the odds of a sustained move are much higher than people think. The market is coiling like a spring, and when it releases, I expect the move to be fast and aggressive. Here's something I learned the hard way, and I want to share it with you because it's the single most important thing in trading. Back in 2015, when the Swiss National Bank removed the floor on euro to Swiss franc, I was long the pair with a stop loss that was too tight. I got stopped out at a loss, but the market then reversed and went much higher. I lost money on a trade that would have been massively profitable if I had just given it some room. That experience taught me that risk management isn't just about setting a stop loss, it's about understanding where the market structural levels are and placing your stop in a place that makes sense, not just a random number. For this swing trade on euro to US dollar, my stop at 1.1500 is exactly 60 pips below my entry. That might seem wide for a swing trade, but it's below the daily swing low and below the psychological support level. I'm not putting my stop in a place where the market can easily hit it on a normal pullback. I'm placing it in a position that the market has to break decisively to take me out. If the market does break below 1.1500 and close below it, The bullish thesis is broken anyway, so I want to be out for there. Scalps. I'm using tighter stops because the time horizon is shorter and the market structure is more defined. My long scalp stop at 1.1532 is below the 50-period EMA, so if we break that, the short-term support is gone. My short scalp stop at 1.1576 is above the 200-period EMA, so if we break that, the resistance is gone. These are logical stops, not arbitrary numbers. The key is to size your position so that a loss on any of these trades is an acceptable percentage of your account. For me, that's never more than 2% per trade. If you're risking 60 pips, your position size should be smaller than if you're risking 10 pips. The dollar amount of the risk is what matters, not the number of pips. I want you to think about risk management in terms of actual dollars or euros, not just pips. Alright, let me wrap this up and give you the bottom line. Euro to US dollar is at a critical crossroads. The 1.1500 to 1.1560 range is the battle zone, and the outcome of this battle will likely set the trend for the rest of the month. My bias is bullish, but only on a confirmed breakout above 1.1560. If we get that, I'm targeting 1.1649 and then 1.1800. If we lose 1.1500, I'm looking at 1.1419 and potentially lowered. Wednesday's US CPI is the catalyst that will likely break this range. If we print soft inflation data, the dollar is going to get hit hard, and the euro will rally. If we print hot inflation data, the dollar could squeeze back, and the euro could sell off. I want you to watch the 1.1560 level on the daily close and use that as your trigger. Now, this is the part where I ask you to take action. If you found this analysis helpful, please hit that like button. It helps the algorithm show this content to more traders who need it. Subscribe to Trade Meridian Decoded with notifications on so you don't miss my CPI reaction analysis on Wednesday night and my weekly recap on Friday. I'll be doing a full breakdown of the CPI print and updating my trades in real time, and I want to hear from you. In the comments below, tell me, are you long euro to US dollar, short, or on the sidelines? Drop your target and stop levels, and I'll read through the comments and respond to the best ones. I'm also thinking about doing a deep dive on the US dollar to Japanese yen next because the correlation with euro to US dollar is fascinating right now. Let me know if that's something you'd like to see. One more thing, this Friday, I'm going to be doing a special edition analysis on the inflation trade and what it means for gold and commodities. If you trade anything other than Forex, you'll want to catch that one. And don't forget to check out my previous weekly market recap from last week where I warned about this exact dollar vulnerability. The link is in the description. Remember, the market is going to do what the market is going to do. Our job is to plan, execute, and manage risk. This is not about being right. It's about being profitable. I'll see you in the next analysis. Until then, trade safe and stay disciplined.